The DOJ just opened a criminal probe into Fed Chair Jerome Powell. And no, this isn't about interest rates directly. It's about a building renovation, or at least that's what they claimed. But if you think this is just about construction costs, you're missing the entire game being played right now. Look, if you're short on time and don't want to listen to some random cat on the internet ramble for 10 minutes, the single most important takeaway is this. When governments pressure central banks, history shows us that markets don't get the easy money rally politicians expect. Instead, you get higher volatility, rising term premiums on long bonds, and compressed equity valuations. The very act of attacking Fed independence can tighten financial conditions, not loosen them. That's the paradox you need to understand before making any moves. Okay, still here and want to know more? Good, let's talk about what's actually happening. But if you're new here, welcome, I'm DataCat. And yeah, that's a weird name, I know. I spent years as an analyst inside a Fortune 50 company. Messy data, models, sitting in meetings where people boast about KPIs, you know the type. I was basically a corporate cat trapped in a cubicle, knocking things off desks metaphorically by telling executives their projections were too optimistic. About 5, almost 6 months ago, I traded the corporate grind for, well, this, lasers, keyboards, and talking to a camera about markets. The channel's still small. I'm not going to pretend otherwise. I don't have a course to sell you. I'm not here to flex some portfolio or tell you I've got secret alpha. I'm just an introvert who likes digging into data and explaining what I find. And honestly, I think there's value in that. Not everyone wants the hype. Some of you just want someone to walk through the logic, show the receipts, and let you make your own decisions. That's what I'm trying to do here. So if that sounds useful, maybe stick around. Hit subscribe if you want. No pressure. Cats don't beg. They only silently judge though. Alright, let's get into it. So just right now, the DOJ prosecutors have opened a criminal probe related to Jerome Powell. Now the stated focus is Powell's testimony about the Fed's headquarters renovation. Yeah, a building project. Now you might be thinking, DataCat, why do I care about some government construction drama? And honestly, fair question. But the context matters enormously here. Powell himself has publicly framed this probe as retaliation tied to rate policy. He's essentially saying, this isn't about bricks and mortar, this is about the Fed's independence from political pressure, and the market agrees with that interpretation. Reuters reported immediate cross-asset moves after this news broke. The dollar came under pressure, gold caught a bid, crypto caught a bid, equity futures weakened. That's textbook institutional risk pricing. Investors aren't trading a renovation scandal, they're trading the possibility that the central bank's autonomy is being stress-tested. This is kind of a big deal, like a cat knocking a glass off the counter, except the glass is the credibility of the world's most important central bank. Now let's connect some dots, because this Powell situation doesn't exist in isolation. Let's take a step back and rewind to January 3rd. The US conducted an operation that resulted in the capture of Nicolas Maduro and has since moved toward US management of Venezuela's political transition. This was framed through security, narcotics enforcement, and most importantly, undoubtedly oil. We've talked about it in last week's videos, but allow me to recap. Venezuela has some of the largest proven oil reserves on the planet. If this transition results in more reliable supply flowing to global markets, or supply that's effectively controlled by US interests, that can mechanically lower crude prices. But why does that matter for Powell and the Fed? Because remember, lower oil means lower headline inflation. Lower inflation means the Fed has political cover to cut rates without looking like it's caving to pressure. It's a pressure release valve. So the administration now has two levers. 1, direct pressure on the Fed through legal and political channels. 2, indirect pressure through engineering a more favorable inflation backdrop via energy markets. This isn't conspiracy theory territory. It's just, how macro constraints interact. Venezuela is a lever on energy and inflation. The Powell probe is a lever on money and financial conditions. Both serve the same strategic goal: easier financial conditions heading into an election cycle. And of course the question is whether it works or backfires. And here's what Wall Street strategists are whispering about that you won't hear on cable news. When governments successfully pressure central banks historically, markets don't respond with gratitude. They respond with fear. Think about it from an investor's perspective. You're lending money to the US government for 10 or 30 years. You need to trust that inflation will be managed competently. If you believe the Fed is now subject to political whims, you demand compensation for that uncertainty. That's called term premium. So even if front-end rates get cut, even if the Fed funds rate drops, long-term yields can rise simultaneously. That's not a contradiction. That's investors saying, sure, you might cut rates now, but we don't trust what happens next. And yeah, that's the weird situation we've been living in for a while. And for equities, higher discount rates compress valuations, especially for growth stocks with cash flows way out in the future. You're essentially making those future earnings worth less today. The cruel irony is this: the administration might want easier financial conditions, but the act of pressuring the Fed could tighten conditions instead. Markets are reflexive. They price in the risk of institutional erosion, and that risk premium works against the very policy goal. It's like a cat chasing its own tail, except the tail is a bond market and the cat is the executive branch, and nobody's having a good time. Alright, let me lay out 3 scenarios for the next few months and what they might mean for your portfolio. Scenario 1, and this is my base case right now, is noise plus stalemate. The probe continues, Powell stays, the Fed keeps doing its data-dependent thing, maybe a cut here, a pause there. Venezuela remains a contained episode with messy politics but no regional spillover that drags in other countries. Market impact, modestly higher volatility, some additional risk premium baked into prices but not a recession catalyst by itself. The biggest effect would be in rates volatility and ongoing pressure on dollar credibility narratives. Manageable but uncomfortable. Then scenario 2, the escalation against Fed leadership. This is the risk-off institutional shock scenario. Legal pressure intensifies, maybe Powell resigns, or there's an attempt to remove him. Maybe a successor gets nominated who's perceived as politically captured. Here's the counterintuitive part. This can be bearish for both stocks and bonds at the same time. Equities sell off on uncertainty. Long bonds sell off because inflation expectations and term premiums spike. The only things that work in this environment are hedge assets, gold, potentially crypto. Anything that benefits from institutional credibility collapse. Reuters actually noted this pattern in the immediate market reaction to the probe news. Gold and Bitcoin bid. That's the we don't trust the system trade. And scenario 3 would be risk on disinflation. This is the optimistic case. Venezuela's transition actually results in more oil hitting the market. Energy prices drop. Headline inflation falls. The Fed can cut rates without looking weak because the data supports it, not just political pressure. If the Powell situation cools down simultaneously, you could see a genuine rally in equities and credit, especially rate-sensitive sectors like housing and small caps. But, and this is critical, this scenario requires the institutional heat to dissipate. If the probe intensifies while oil prices fall, investors might not trust the setup. They'll see lower inflation, but also see a compromised Fed. And those two signals will fight each other in portfolio positioning. Technical-wise, I'm not saying the market is going to break today. As a matter of fact, last week's market structure came out better than I expected. But since we are at market highs, this kind of event risk could often produce sharp, tradable dips and fast regime shifts. So brace yourself this week, and practically speaking, what should you be monitoring? First, any official DOJ filings or subpoena details. Watch whether the focus stays narrow on renovation testimony or expands into something broader. Scope creep would be a bearish signal for institutional stability. Second, signals about Fed leadership transition. Timeline, successor names, market perception of their credibility. If markets smell a political appointee, you'll see it in Treasury volatility first. Third, the Treasury term premium. Are 10-year and 30-year yields rising even while rate cuts are priced into the front end? That's the we don't trust you indicator I mentioned earlier. And fourth, the credibility basket. This is the cross-asset signal. Dollar versus gold versus inflation break-evens versus equities. If gold and break-evens are rising while the dollar and equities are falling, that's institutional credibility bleeding out in real time. So look, the cleanest interpretation isn't that Venezuela and Powell are some unified conspiracy. That's too neat. Real governance is messier than that. And no, I'm not trying to pretend I understand politics here. My cat does a better job than me when it comes to observing human stupidity, but they do interact through macro constraints. Venezuela affects energy and inflation. The Powell probe affects money and credibility. Both serve a coherent political posture, which is maximize executive leverage over the constraints that determine growth and inflation optics. The real risk that institutional investors are pricing right now is that attacking Fed independence backfires. You raise the term premium, you raise equity risk premiums, you tighten the very conditions you wanted to loosen. That's the paradox, and it's playing out in real time. So, be careful this week. If this helped you think through what's happening, and more importantly, what to watch, I'd appreciate a like. Helps the algorithm, helps the channel grow. If you want more of this kind of breakdown, subscribe. I'll keep doing these as long as the data's interesting. And hey, if you've got questions or pushback, drop a comment. I read them. I'm a cat. I only pretend I ignore you most of the time. Alright, that's it for today. DataCat out, and I'll see you in the next one.